Now that why is very important. And I will share with you one very interesting point that when Newton, you have heard about Newton, who has come out with a gravitational law. Now, Newton, Apple must have fallen down on so many people's head just even before Newton, but it was only Newton who asked why. And that's how that entire thing came out. So we have to be always alert and ask that question why, as to why this particular thing has been introduced. And that is what we are going to discuss over a period of next 2 hours. I will share all my practical experience of several 36 years, what I have actually worked on, and then I'll try to see that how you can get the maximum out of this tax audit seminar. So let's first understand as to what is the first of all, what is the applicability of tax audit? Because when we start the audit, we should know whether the tax audit is applicable. Otherwise, there is no point in just doing an audit without having it applicable. Now, first of all, this tax audit comes out from section 44AB, and there are various subsections which define when the audit is required to be done. We will deal with first a small a, 44AB small a, which deals with business community, business people. So if your turnover of the business is more than 1 crore, then tax audit is applicable under this section. There has been a relaxation because this government intends to give you more impetus on the banking transaction. So when you have more of banking transactions, 95% of your transactions are through banking channels, either through Pays account check or through ECS. All this now online payment, GPay, everything is very much in vogue. So if you have those 95% transactions through banking channels, now what constitutes this banking transaction? The section says receipt and payment. Now, receipt and payment does not necessarily mean any receipt. It is only related to your sales income, and the payments relate to your expenditure. Suppose if there are cash withdrawals and cash deposits in the bank, which may be more than 5%, but still, if your receipts of the sales and payments for expenditure are within that 5% thing, you are still getting the higher limit of 10 crores instead of 1 crore. So if your banking transactions are more, up to 95%, then you can still avail the limit of 10 crore for the tax audit, and you are not required to do tax audit up to 10 crore. So that is an benefit given to the business people, that they can avoid tax audit. As far as the professionals are concerned, the limit is 50 lakhs. Now it has been increased to 75 lakhs from the current financial year, but till March 23, it was 50 lakhs. So we have to apply 50 lakhs limit. And there is no such ceiling, no such relaxation for the banking transactions. You have the same limit. Now, there is, of course, certain presumptive taxes. Now, why this presumptive? You will hear a lot of this question, why during the entire next 2 hours? Why do you think the government has given this 44AD and all this section, the presumptive tax? Because there are so many small traders, and for them to maintain books of accounts and get all these things done properly, it is very, very difficult. And even for the assessing officer to, assess those kind of small traders, it becomes very difficult. So what they have done is government says, okay, look, we will accept whatever you are saying, provided you pay 8% of your gross receipts or sales. If you pay the tax. Now, of course, here also there is a relaxation. If your banking transactions are there, then it is 6%. So, you get your impetus is given more on the banking transactions, and incentive is given to do more of banking transactions. If you have a cash transaction, major cash transactions, then it is 8% in terms of your profit. And if it is a professional, then 44AD applies, and then 44ADA applies, and then you have got 50% presumptive income. So if you declare this presumptive income, then you don't need any tax audit. So the government will also accept your return. Now your limit for this 44AD is not 1 crore, it is 2 crores. Means up to 2 crores if you have a turnover, and if you are declaring 8%, then you don't need any audit. Now here again 44AD is very, very tricky. Under 44AB into bracket E, whatever presumptive taxes, anyone who falls under presumptive taxes but requires audit comes under section 44AB into bracket E. And here they have referred not 44AD1 but 44AD into bracket 4. Now what is 44AD4? 44AD4 says that if an assessee has opted for presumptive tax in year 1, that means for the next 5 years he will have to continue to declare the income as per the 4480. That means he has to declare compulsorily either 8% or more. Nowadays, it's not just 8%, either 8% or more, whichever is actual. And you will continue to declare this for 5 years. Now, if you do not declare, suppose in the year 2, you realize, you know, I want my income is not so much. I want to pay only 2% tax, 2% income I want to declare. So now in that situation, you will have to get your account audited, and that audit will be under 44AB into bracket E. Now, suppose your turnover is between 1 to 2. That means you are in a different, range. Now you are up to 1 crore. You are not required to get the accounts audited under 44AB-A because the limit here is 1 crore. Now, the moment you exceed 1 crore, you are under 44AB-A. But then, suppose if you declare 8% up to, if your turnover is up to 2 crore, you are still eligible to declare income at the rate of 8%. So you still come out of the audit. So you don't require an audit. But suppose you don't declare and your turnover is 1.5 crore and you don't declare 8% and you declare 5%, then your audit is under 44AB into bracket E. So here we will have to say that because it is the, and now if your turnover is above 1 crore, but if you have not declared the profit as per 8%, then the audit will be under the normal 44AB-A and not 44AB-E. Only when your turnover is up to 1 crore and you have not declared profit as per 8%, then you are under 44AB into bracket E. Now, if you are above 2 crores, then 44AB doesn't apply. You have to go under 44AB-A. And here you have got either 1 crore or 10 crore, depending on your cash transaction. So this is the principles on which this particular section or the applicability of tax audit works. Now here there is very important is the form 3CA or 3CB. Now what is our auditor's responsibility? We are very clear, and the institute also is very clear. The tax audit, the guidance note, which sir has referred in the earlier opening remarks, is that the 3CB is the prerogative of the assessee. It is not that the tax auditor makes 3CB. Tax auditor does not make 3CB. It is what does the tax auditor do? Tax auditor verifies 3CB. Who will prepare the 3CB? It is to be prepared by the assessee, the company or the entity, whoever it is. They have to prepare the 3CB. What is the role of the auditor is to check that 3CB and find out whether that is correct or not. And here the certification of 3CB is true and correct. As far as the financial statements are concerned, always the reporting is on true and fair and not true and correct. Whereas as far as the 3CB is concerned, the particulars given in 3CB have to be certified as true and correct. So there is a difference between true and correct and true and fair. True and fair has got a lot of subjectivity involved. True and correct has got arithmetical accuracy, so there cannot be any subjectivity. You can't say two things are correct. No, it cannot be. Either one is correct or wrong. So you have to see whether the arithmetical accuracy is 100% in case of 3CB. So you cannot miss out any items. Now, as far as 3CA and 3CB is concerned, when do you use 3CA and when do you use 3CB? 3CA is used only when that assessee is required to do audit under any other law. For example, if he has got, it is a company. Now, company has got a statutory audit under the Companies Act, or an LLP also may require certain entities, certain LLPs to get themselves audited under LLP Act. So now in that situation, there will be a separate audit report of true and fair under those acts and not under the Income Tax Act. So now the auditor, tax auditor, when he is preparing 3CB, now it could be the same one, the same auditor who has done the audit under the Companies Act or LLP Act can also be the tax auditor. It is not necessarily there could be a separate auditor. So he will rely on his own report, which is given under the Companies Act or LLP Act, or if there is another auditor, he will rely on that auditor's report to give true and fair as far as the other the auditor's report is concerned, and then he will refer to that report, and in the 3CA it will be referred to that report and not to his report. Now he will only refer to his 3CD and say this 3CD is true and correct. So as far as true and fair is concerned, he is not giving any update on true and fair. He is giving only update on true and correctness of the 3CB. Then he is only relying on those true and fair given by the either himself as an auditor under a different act, or another auditor who has done the audit under the Companies Act or the LLP Act. So here, there is one more very important aspect. When you are doing an audit under the tax audit, 3CA or 3CB, under 3CB, it is where there is no audit. For example, partnership firm. Partnership firm does not require any audit under the Partnership Act. So what do you do? Now the auditor will have to do the audit even of the financial statements and say that yes, these are true and fair, and this true and fair will come out in 3CB. There is no 3CA to be given, only 3CB, because 3CB is a report of the entire true and fairness. And he will, as a tax auditor, will also report on true and fair, as well as he will report on the 3CB about the true and correctness of 3CB. Now, if you see our SA 700, which prescribes the format of the audit report, and that audit report has been, standard audit report has been prescribed by our Institute of Chartered Accountants of India, and that particular standard is binding on the members of the institute. So now, if this 3CA and 3CB, if you see the format which has been prescribed under the Income Tax Act and which you have to upload as a tax auditor when you are doing the tax audit, you have no choice of modifying this particular report. You cannot modify. So what do you do? But you have to still comply with standards of auditing. The institute doesn't give you exemption because there is a standard format. You can still comply with that, and you did not comply with our standard. No, you still will have to comply with our standards of 700 on the format of the institute. Now, how do you comply both? You will have to. You cannot modify the tax audit report of 3CA, 3CB. So what you have to do is whatever is the differences between that format of the income tax and what is the difference between the SA 700, those clauses, suppose there is the auditor's responsibility, management's responsibility, or whatever is extra to be given as far as the format is concerned, those will have to be given as a part of the observation. There is an observation section in the 3CA or 3CB where you can give your own observations about the audit report. And in that observation, you can attach a sheet, annexure, and you can attach an annexure giving the format or the clauses which are not there in the 3CA or 3CB, but which is there in your SA 700. Reproduce those no clauses into that particular annexure and submit that annexure along with your tax audit report. And if you are not doing it, then it is a non-compliance of SA 700, and it is very serious matter. I must tell you, all the members, that you must take care of this particular aspect if you are not doing it. At least from 23 onwards, you please handle this, because it is a very serious matter. It amounts to a non-compliance of the standard of the auditing, and which, if there is a disciplinary matter which goes up to the institute, then yes, we will, the member will, in question will be problem. And let me share with you, the 3CD format is very critical. We have to be very thorough in verifying. I've got a separate agenda. Last slide is there, which talks about how are we going to do the audit. What are the methodology? What is the process we are doing to do the audit? And when you will realize what are the processes to be done, if there are any lapses, then there is a major serious discrepancy. There is a circular from CBDT to the various discs. If there is any discrepancy found between whatever the tax auditor has submitted, then the case can be referred to the disciplinary action. And also there is a section which is introduced from assessment year 23-24 onwards, 271 J, I suppose. That section says that if the tax auditor has made any error in the tax audit report, then a penalty can be levied not on the assessee but on the auditor. So you can be penalized under the Income Tax Act if the assessing officer doing scrutiny assessment finds out if there are any errors in the tax audit report, which is based on which, because what happens is the 3CD, the way it is designed, it is used mainly to prepare the computation, because a lot of information from the 3CD goes into your computation, and that computation is then used by the assessee to file its return of income, and the assessing officer will verify those things with your tax audit report. And if found that some errors are there, because of this there is a misreporting, then even the auditor will be in trouble, because the auditor is supposed to give true and correct information in the 3CD. So this is our agenda today. There are 44 clauses in 3CD, and don't go by 44 clauses. There are actually 102 such sub-clauses. Including the sub-clauses, there are totally 102 questions which we are supposed to answer. So it's not a small 3CD, it's a large 3CD. And we, with the 2 hours, we cannot cover the entire 3CD. It is impossible. What I'm going to do is, as already sir rightly mentioned, is we are going to take up the important issues, critical issues which come out during your audits, and I will try to deal with it as to how are we going to handle those issues. Agenda is to discuss important clauses with issues. And last but not the least, audit process and documentation, which I would like to share with you as to what is the process that we will have to follow to see that our audit is perfect. First and foremost, the registration under various direct, indirect taxes. Now, there is a very simple clause, and we answer it very mechanically, that it is asking us the GST number and all that indirect tax number. So we give a number, or the assessee gives a number, and we verify those numbers. Now, sometimes it happens that the assessee is required to register under the Indirect Tax Act, but has failed to register under the Indirect Tax. So he doesn't have a number, so he has not reported a number. Now, what is the responsibility of the auditor? The auditor cannot say, okay, number nahi hai, chalo, okay, number nahi diya, to kya kar sakte? But no, it is not that. If the number is not there, what is the requirement? See the question, whether the assessee is liable to pay indirect tax. That is a starting point. So when the question is to the tax auditor, whether the assessee is liable to pay indirect tax, so we have to say whether yes or no. So if he is liable to pay tax, and if he has not registered, then there is a qualification. Yes, he was liable for the, suppose for example, his turnover is more than 40 lakhs, or his service revenue is more than 20 lakhs. And for some reason, he has not got it himself registered. Now, the number is not available. So what you have to do is, as a tax auditor, we are supposed to say that although he was required to be registered under the GST Act, he has not obtained the registration number. That naturally, there is no question of giving a number. But then this qualification has to come in our tax audit report. So you cannot just miss out just by saying no number. Now, details of reconstitution of any firm, or if there are any changes in the partnership firm or AOP, this is what is supposed to be mentioned. So we are supposed to see the deed of partnership or AOP, which is the latest, and we have to also see whether it has been filed with the register of firms and whether it has been properly documented. So now here, what is the change in constitution? Change in constitution refers to the change in the partners, because if there are admission, retirement, all that has to be mentioned. If there is a change in the profit sharing ratio, that also has to be mentioned. But suppose if there is a slight, the only change is the change in the salary of the partners, whether that constitutes change of the partnership, no, because that is, see, if you refer to the guidance note, which sir has mentioned initially, there is a guidance note which was prepared, and I'm glad to know that about 5 members from Calcutta region has contributed immensely. Even I was part of that team which reviewed the entire tax audit report, and we had a lot of discussions and deliberations in this matter. And we knew now basically what is the fundamental principles under which the guidance note is prepared. This guidance note is going to be your guiding point when you do the tax audit report. Keep that guidance note with you. Even now they have come out with a ready reckoner of this. So it is a fast reckoner. You can easily refer to certain important points and come out with it. So here the guidance note also, it is clearly mentioned that these are the 2 things which we are supposed to give as a change of constitution, and change of salaries, etc. will not be referred here. Yes, there is a separate clause under 40B which is to be referred to, which we will discuss little later during the discussion, where the partnership things have to be discussed, salary things have to be discussed. Maintenance of books of accounts. See, ideally, it is a very simple question. What books are maintained, what you have examined, all that thing we will mention. Who are required to maintain books of account? Under 44AA, there are only few categories of people who are required, where the books have been prescribed. Of course, books are required to be maintained by various categories of assessees, which I am coming to it a little later. But whether they have been prescribed, which prescribed is only doctor. In case of doctor, they have prescribed a case register. Now, what is a case register? When any patient comes into their clinic, they will write the name of the patient, what is the amount, and all that is meant. That is a case register. So that case register determines what is the revenue of the doctor. So that is compulsory, it's mandatory. And if you're doing an audit of a doctor, then you must see that this case register is maintained or not. And if it is not maintained, then you are supposed to report as a qualification. Now, as far as the other entities are concerned, there is no as such prescribed books. But what constitutes books of account? It is basically cash book, ledger, you've got general ledger, sales register, purchase register. These are the standard books which we as a chartered accountant know which is required to be maintained. Now, it also asks you where is the location of the book of account. The location is very, very difficult. Earlier, yes, when it was manual or it was only one server where it can be kept, one server is kept and people are working on one tally, and they were working on it. So they know where the particular thing is located. But now with the cloud environment, you don't know where the servers are located, because you are logging from anywhere in the world. You can sit on your laptop anywhere, and then you have just got a password, user ID, and you log in, and you get access to all your accounts. Now, where is the server? Where is the account? So the most important point is that where the server is, because that is where your accounts are. And even one more thing, that is one part of it, where you are routinely accessing your maintaining data entries of the accounts are being done. That is also the place where the accounts are maintained, because if your team is maintaining accounts from your office, sitting in the office and entering the data, yes, the accounts are maintained there. Plus, the server may be residing somewhere, you don't know, it might be, but of course, when you do the agreement with the server person, he will tell you that server is located in US or anywhere in the world. So that also is a location, but mainly where your accounts are being entered. You can access anywhere, but accounts are entered by some accountant in some location. So that is the place where you can mention. Now, who are liable to maintain books of account? As I mentioned to you, that the people who are carrying on business and profession, if their income is greater than 120, and if for individual and HUF that income threshold has been increased to 2,50,000, and the sales gross receipts are more than 10 lakhs, for the individual HUF it is 25 lakh rupees. So this is the requirement that they have to compulsorily maintain books of account. Now, when you are in the presumptive tax 44 AD, then the assessing officer will not ask for books of account. That is doesn't necessarily mean that you don't have to maintain books of account. But you will not be questioned on the books. You will not be required to present those books to the assessing officer. But yes, you should maintain books, because how will you determine your turnover? How will you determine the profit? Because in any case, the 8% criteria is not that flat 8%, whichever is higher. So you have to compute your income in any case. Now, there are other relevant records. Suppose what the stock records are not maintained. Now, in some cases, stock records are not maintained. For example, there's a trader, and the traders are having so many items that it is impossible for him to maintain stock record, because he has to maintain somebody to maintain stock record, which is very expensive for him. He will not do it. And it is cumbersome also. Daily is having turnover. So even if he has not maintained stock record, he is still offering whatever. But as an auditor, you are supposed to say that because of the nature of business or the turnover or the type of transaction, the SSE has not maintained the stock record. So this point has to come into your audit report. Now, location I have already mentioned to you. Stock records where it is mentioned, I have already explained to you. Now, there is a clause 12 on the presumptive profit. We are required to compute. Suppose if the assessee has got 3-4 businesses and one business has got presumptive tax. So in that presumptive tax, if it is various what is the amount he has quantified as 8% or whatever profit he has quantified, that needs to be disclosed, and which is the eligible business and what the eligible assessee. Companies are not eligible, LLPs are not eligible, firm, individual proprietor are eligible. Now, mind you, for the purpose of Income Tax Act, LLP is also considered as a firm, but for the purpose of this section, they have eliminated LLP. Okay. Now, method of accounting. Method of accounting, cash and accrual method is only permitted. Hybrid system is not permitted. Now, the Income Tax Act permits you to do cash or accrual, but there is a Companies Act which says no, only accrual. So where there is a corporate entity like company, you have to compulsorily follow accrual system of accounting. You have no option of following cash system of accounting, although income tax permits you, because there is an overriding act, Companies Act, which governs companies, and that says no, you cannot have a cash system of accounting. Whereas other entities can follow cash system of accounting. Whatever is received is the income, whatever is paid is the expense. So this is the principle we follow in the cash system of accounting. Now there is a new 3 clauses which were introduced some time back, and that is 13D, E, and F that deals with ICDS. Several years back when this ICDS was being introduced, before that the name which was given was TAS, Tax Accounting Standards. And when that was just as it was not even introduced as a law. It was just as a some sort of a draft form. It was introduced to deliberate and discuss. At that stage, our institute started, conducting various seminars, and so that members are already aware about how to deal with it. And in one of the lectures, I mentioned that when you say TAS, it is Tax Accounting Standard, and if you see the main principles behind this TAS, it says you are not to pass any entries in the books of account because of this TAS. So how can you say tax accounting standard? How can you name it as accounting standard? So we've deliberated and discussed, and then probably this matter must have gone to the finance ministry. And when ultimately, when this thing was framed, it was renamed as ICDS, Income Computational and Disclosure Standard, because in that situation, you are not touching the books of accounts. You are only, giving adjustments in the computation of income, which is outside the books of accounts. So all the adjustments are now happening in Excel. There is no adjustment happening in the books of account. Now, why? My favorite question, why this ICDS was introduced? The reason why this ICDS was introduced, because accounting standard per se permits some few alternative options. Now, alternative options are not something for the matter of any tax planning. It is not for that, but it is for the correct accounting presentation, because when you are doing an accounting standard, there will be so many different types of entities, so many types of situations where you cannot have just one straight jacket type. Okay, aisa hi karo. It doesn't happen that way. So you need to have alternative situations for different situations. Like, for example, we have in one thing called retention. When a contract is given for a construction contract or any contract, there is sometimes a retention clause for 10% of the amount. For example, if the contract is given for 1 crore, generally there is a retention of 10%. They say, no, I will not, the customer will not pay 10% for 1 or 2 years, which is mentioned in the contract. Why? Because there could be some leakages or some defect work. So to avoid, to make that contractor carry out that defect work, the customer will hold back 10%. And they said, no, I will not pay you unless and until 2 years pass and nothing is there, and then I will release this 10%. Now, in that situation, there are Supreme Court judgments. There are so many judgments prior to this ICDS saying that this 10% retention cannot be an income of the contractor unless and until that period of 2 years have passed or that money is released. So that 10% was always deferred. And to the last 2 years, after 2 years, and it was never recognized. Up to 90% they should recognize the income. Now ICDS says no. Irrespective whether you do whatever contract between the two parties, we will tax this 10% immediately. When the work is done, the contract is executed, and there is a percentage of completion work going on, we will tax this 10%. We will not give you this deferment of retention income. Similarly, there are other items like warranty cost. Suppose I am buying a computer. Somebody is selling me a computer for 1 lakh rupees. Now, he has given me 1 year's warranty. That means he will be servicing this particular computer for 1 year. Naturally, he has built in some cost for his warranty. He is not going to do it free of cost. Although it appears free, but you are already paying for it because 1 crore includes that warranty cost. Now, suppose, for example, he has sold this computer in March 23, and it is a 1 year warranty which will run till March 24. Now, the cost may not will be incurred in the next year. Suppose if the computer works fine for the next 1 year, no cost will be incurred by that person. But suppose if that after 1 month, the entire computer is spoiled, he will have to replace the entire laptop, because he has given a warranty. And that means he is 100% loss. Now, in that situation, when he is recognizing 1 lakh rupees as an income in March 23, then he must also recognize some cost which is going to come in, because there has to be a matching concept. Cost and the revenue has to match. Now, if the revenue comes in 1 year and cost in subsequent year, it is not correct accounting wise. So how do you deal with it? AS 29 comes into play, and AS 29 says, yes, you can recognize the estimated cost. Now, the cost is not yet incurred, but you still make a provision. Now, how do you make a provision? We are not God. Okay, we will know after 1 year whether how much you will spend, whether this machine, the laptop will get spoiled or not spoiled. So what do? The standard provides for it. Okay, you go back last few years and check whether how much he has actually incurred on warranty. What was his sale versus his sale. Suppose if he has incurred 3% of his total sale revenue, he'll make a provision of 3% on an estimated basis. Maybe next year his actual cost will be 5%. So that time he will debit extra 2%. But today you provide 3%. So this is how the standard provides this. But ICDS says, no, we will not allow any such expenditure which is not yet incurred. We will disallow this. We will allow only actually when you spend. Suppose if you don't spend, no deduction. But if you spend 5%, you will get 5% deduction in the subsequent year, not in this year. So there will be a mismatch. There will be a timing difference. In your accounts, you will provide as per the AS 29 is concerned, and ICDS says disallow in the income tax return, make an adjustment, and you claim only in the subsequent year when you actually make the payment. So this is the difference between the ICDS and your accounting standard. So these are standards, but these standards are different than what is your accounting standard. So you will have to prepare a reconciliation between those two things. What is debited in profit and loss account and what is computed as per the ICDS. And that difference you will have to reflect in your 3CD, in this clause 13D, where you have to even give the amount. What is the amount by which the amount of the profit is going up, and how by what amount the profit is going down. It may happen that profit can also go down. How it can go down? Suppose in the year one, you have disallowed the warranty expense. So naturally, you will have to add back. So that means the profit will go up. In the second year, when you actually incur expense, but books will not show that expenditure because book has not provided. Book has provided in the earlier year. So now you will reduce the profit in the year two. So these adjustments will happen in your computation. And for that tax audit, what is the material available? The Excel files. Now the audit here becomes very challenging because we are auditing not books, but we are auditing the Excel files. See, generally we are supposed to audit the books of accounts and then say whether they are true and correct or whatever. Now here we are auditing not only the books, we have to compare books with the Excel file. So it becomes more challenging. And there are 10 such ICDS. And each ICDS will have some adjustments. There are so many such adjustments. One another example is our contractual contracts, A7. A7 says that if in the year one you estimate that there is some profit, so you work out your percentage completion based on that. In the year two, suppose for example in year one you have estimated a profit of you have estimated a profit of 20 lakhs on the entire project, and the 50% work is done, so you will recognize profit of 10 lakhs in the first year. Second year, you find that there is something major change in the environment, economy, the structure or whatever, and the costings have gone up, and you are not going to make profit, but you are going to incur a loss of 10 lakh rupees. Now the standard says, A7 says, that don't go by the percentage completion. Now, except the work is only complete to the extent of 60% in year at the end of year two, then you don't recognize loss only to the extent of 60%, but recognize 100% loss in year two, because conservative principle. When you follow conservative principle, you recognize loss at the first moment. Don't wait for the subsequent event. Now, ICDS says no. You will continue to get the same loss in the percentage completion method and not as per the total loss in the 1 year, not as per what the standard says, not our A7 says. So you will have to, add back that loss, whatever you have claimed, and then only claim only what is the percentage completion. Suppose if you have added back 100%, you will have to claim only 60% loss, so 40% will get deferred. Basically, if you observe this 10 ICDS, you come to one conclusion. What is that conclusion? Wherever any income is getting deferred because of accounting standard, ICDS preponderant. Whenever any expenditure is getting preponed because of standard, accounting standard, ICDS deferred. So this is the basic principle on which the ICDS is working. Now, there is one very interesting point. We have to look at one thing very interesting. When I'm saying that there is year one and year two, there is no actual loss. It is a kind of timing difference. You are not losing the deduction at all. You will get deduction, maybe not today, but tomorrow. So now that amounts to a timing difference. And when there is a timing difference, one accounting standard triggers is AS22, that is a deferred tax. So whenever you are implementing ICDS, which is applicable, you have to ensure that you also give effect to the AS22, the deferred tax. And if you have not done that, there would be a violation in AS22 and your standards are not complied with. Now, this ICDS applies to whom? It applies to all entities who are following mercantile system of accounting. Who are following cash system of accounting, it doesn't apply. And there is no threshold, small companies, small, big companies, turnover, no criteria. Yes, there is only one exception. If individual and HUF who are following mercantile system of accounting, who would otherwise be liable to comply with ICDS, will not be liable to comply with ICDS if they are not under tax audit. So if individual HUF are under tax audit, irrespective, they will be required to comply with the ICDS. But if they are not under tax audit and if they are following mercantile system of accounting, then they will be exempted from ICDS. And others, partnership firm, even if they are not under tax audit, still they will be required to comply with ICDS. So it is a far-reaching, it has got a huge impact in terms of the reach. You have to maintain all these adjustments in Excel. So as an auditor, we have to ensure that these files are properly protected, edited. You cannot edit. Otherwise, after 2 years, when you refer this file, if it is edited, you will not know, you will lose the full track of it as to how did you work out, because you have to go back to the earlier years when that adjustment was made and then come to that how your adjustment is reversed. There is a borrowing cost, totally different method. A16 is different. This ICDS is different. So there is a difference in both the methods. So you will have to be very careful of maintaining those records. Of course, ICDS is a separate topic by itself. And if I start talking on that, maybe we will have to go for dinner and breakfast also together. So that will be a difficult situation. But I'm just sharing with you some really important highlights. And as I said, why highlights, I've already explained flexibility of standards, and they want to avoid those flexibility. This leads to avoidance of double taxation. But as I thought, the basic objective is to defer the expenses rather than. Now it is applicable from assessment year 17-18. It's already almost 4 or 5 years we have been implementing. It applies to all entities. It only applies to 2 sources of income, that is a business and professional income and income from other sources. Naturally, other source of income really do not have impact on ICDS, like salaries, capital gains, house property income, and all that doesn't really have an impact on ICDS. And it is only for computation and not for maintaining books of accounts. Now, this is a very, very serious and important clause 16. People take it very lightly. Income not credited to P&L account. But we will be very careful reporting figures here. Because if you see several clauses in that, which is that scope of section 28. 28 is a very wide term. You know one scope of 28? 28, there is one sub clause in 28 which says that any perks that is received by a business person, then that is taxable under section 28. For example, suppose if there is a businessman who is doing marketing, freelance marketing for various companies. Okay, he is doing freelance marketing, and he's got a tax audit, and he is under tax audit. And you are a tax auditor for that marketing person who is a professional, and he is doing marketing for various pharmaceuticals and various companies. Now there is a practice in these companies where they provide some holidays and incentives in kind. It could be some, tours outside India, and okay, you go and have a nice tour outside India and travel and enjoy. And basically, they're trying to motivate those people so that they do more business for them. So it is basically in kind. The payment is never made to this person, but he travels. All the tickets are booked, hotel is booked. Now, there is a section in the 28 which says that there is a perks, and that perks is taxable in his hands. So far, there was no trigger. People never came to know that. I mean, as a tax auditor, how will you know that he has gone to some country for a holiday? You will never know, because no check has come into his account. It is basically the company has incurred the expenditure on his air travel and his hotels and everything, and he has gone and come back. Now, as an auditor, no entry in the books of accounts. So how will you know that there is an income which is never credited to profit and loss account, because he's supposed to offer that as an income under that section 28. Now 194R has been introduced primarily for this. We will discuss 194R separately when we discuss TDS, because it is one of the most dangerous TDS provision which has been introduced. And 194R deals specifically for this. If there is any perks on which there was earlier no TDS, perks in form of a kind, which now if the company is issuing some benefit to any businessman or a professional, then that triggers a TDS. And when there is a TDS, definitely it will get reflected in this 26AS or whatever. And then the auditor will also can look at this 26 and find out if there is a 194R classic TDS deduction, then he may immediately come to know that some benefit has been given, and then he can check that whatever is the benefit, and that will be reflected. So there are many other, like another example I will give you. 224. 220 earlier, any capital grant was exempt from income tax initially, earlier. So AS12, whatever capital grant received from the government was to be credited to capital reserve and was never taxable in the hands of the assessee. There was a Supreme Court judgment, Sawney Steel judgment is there, and because of that, that capital grant was not taxable. But as far as AS12 is concerned, it required and still requires now also to credit that amount to capital reserve. So it does not come part of the P&L account. But now that section 224 has been amended and has made this grant as taxable. Virtually most of the grants are taxable except a few. I mean, nothing has been left out in this case except what you deduct from the cost of the asset, which is directly meeting the cost. But otherwise, most of the grants received from the government are taxable. Now, in that situation, this grant is credited to capital reserve. It is not credited to P&L account, but it is a taxable income. It is an income under section 224. And when it is an income under section 224, and if it is not credited to profit and loss account, it requires a disclosure in this particular clause 16. So this you have to be very careful that we pick up all those transactions and report this here. Then there are escalation claims accepted during the previous year. Now, how will you find out accepted? Accepted for which there is no entry in the books. There is no debit note. There is no credit note. It is only internally the SSC has gone and agreed with the some person supplier. Okay, I will pay you extra. Now, how do you? I will receive extra if your customer has agreed. Now, that is all by correspondence or by emails or maybe verbal. Now, how as an auditor? So it is to be a representation. You have to ask questions to the assessee, and assessee has to reply in writing that yes, there are escalation clause or no escalation clause. Or if there are any contracts where you can directly send a confirmation to the customer saying that are there any escalation clauses which has been accepted or not. Now, here there is one very interesting point which you face in your income tax. Now, we have got a solution for that also. What happens is, there is any other item of income. Clause D, 16D is a very, very dangerous clause. Generally, in a case of a proprietary concern or an individual, his P&L account is made for his business, but he also has a capital account. Now, suppose if he has got rental income, if he has got dividend income, if he has got interest income, all that is not credited to his profit and loss account because it is his personal income. It has nothing to do with business. Now that goes and credited to the capital account. Definitely, it hits this particular clause 16D, which says items not credited to P&L. It's not credited to P&L, it's credited to capital account. But still, the assessee is going to offer that income. He's not going to hide it. He's going to offer it in his income tax computation. He will show rentals, they will show income from other sources, everything he will show. But as far as this clause is concerned, it requires reporting. Now, there are two choices. One, suppose if the assessee shows those items in this clause 16D, that these are the items not credited to P&L account, the CPC, what it will do is, it will pick up those items straight away without asking that question. It will only ask, okay, whether you accept or not. And even if you say not accept, it will straight away make an adjustment to 140 under 143.1. And I'm sure you all must have faced this problem. We also have faced a lot of problems like this. Now, what they will do is they'll make an addition, they will calculate interest, they will calculate all this kind of thing, tax and everything, and they will send a demand to the assessee. And if you keep rectifying, but few times you rectify, the same answer will come. Unless that particular matter is referred to the assessing officer who is physically present, and then you go and explain, look, this income is already offered, now you are adding double. It's a double taxation, you can't do it. Then he will remove that, and he will rectify it. But the CPC will not understand, it is a computer based. Now, how do you solve this problem? So, see, as I said, 3CD is not an auditor's form. It is the form to be filled up by the assessee. So what the assessee generally do is, okay, we will not disclose this because we are offering this income in our returns. So we are not going to disclose it as an amount not credited to profit and loss account. So he will not disclose this in 16B. Now, what as an auditor we are supposed to do? We can't force that person that you disclose because it is his form. Like in our balance sheet, we cannot force the client or the auditee that you make this provision as per the standard. We cannot. What is our weapon? Our weapon is the audit report. So what we do is, in the audit report, in that notes, You give all the disclaimer, all the disclosures. Okay, yes, the assessee has not disclosed this particular income in this particular clause 16. It may be a qualification, and it will say that in this particular clause 16D they have not disclosed this item. Now, if the assessing officer looks at this clause and says, "Oh, you have not disclosed," but then the assessee will say, "Look, I have already offered," so then there is no question of double. So then at least there will be a discussion. Here, automatic additions will not. Here, because it is reflected in clause 16D, automatic additions happen, and that is really painful. It triggers interest and all that, and number of time goes into rectifying this. Now, what does phrase capital receipt mean? Suppose if there is a capital contribution like gift, of course, gift under 56, if it is taxable, yes, because the gift may not be credited to P&L account, it might be credited to capital account, but it is definitely in income. It's in a section 56. So naturally, you have to report this. Now, 43CA and 50C. Now, my very favorite question, why these sections were introduced? This section were introduced to curb certain unearned, black money, so that any transaction which is happening for own money will be curbed under this particular section. There were other measures the government had started, but that didn't work. So they came out with this section. Now, what initially they came out with 50C. 50C applied only to capital asset, but then they realized that there is so many transactions happening even in the stock in trade, because builders sell the real estate assets, which are basically stock in trade, and 43CA then was introduced to cover those aspects also. Now, what is 43C and what is 50C? What it says is very simple. They say that if your agreement value, the consideration as per the agreement, is higher than or equal to the government ready reckoner value, that is the government rate. Government publishes this rate over a period of time and keeps on revising it. So if your agreement rate is more or less equal or higher than the government rate, then we accept that and we feel that there is no on money is passed. So that is the presumption which will come up. Then came a stage where there were some reductions in the pricing, because real estate never had a downfall, but sometime because during COVID, there was a reduction in the prices of the real estate, and the government realized, and there was a lot of representations being given, and the government then gave some concession. In fact, some concession was given even prior to COVID, because the real estate department, the people lobby, told the government that, look, the real estate market is not growing. We cannot get higher price sometimes. It is a distressed sale also, because there's so much of stock, you can't sell. So they came out with a threshold 10% margin. Okay, we will give you 10% buffer. Suppose if initially it says stamp duty value or higher. So if that was the case, then your agreement value is okay. But if it was lower, then the stamp duty value or the ready reckoner value was considered as a sale value. Then they gave you 10% leverage. Okay, we will give you 10% margin. In case if the difference is 10%, we will ignore it and we will still consider agreement value as a sale value and not the ready reckoner value. So now I will come to that as to how do you compute this 10% is very important. And before we go into that, let me just explain you the disclosures what we are supposed to give in our audit report, because we are concerned with that. We are not concerned with but we should know how to compute that difference. We are supposed to give details of the property under which this particular difference is there. If there is no difference, then you're not supposed to give this disclosure. Only where the difference is either the agreement value is lower than the stamp duty value and it is below that threshold of 10%, then only this reporting will be applicable. What is the consideration received or accrued? That means what is as per the agreement, what is the consideration, and what is the value adopted or assessed as per the government ready reckoner rate. Circle rate, somewhere it is called circle rate, somewhere it is called government ready reckoner rate, somewhere it is stamp duty value. In India, various state subjects, so generally it is used in different states. So whatever is the amount that is given in the circle rate or in the agreement, there are two rates are mentioned. So we have to pick up those two figures and give the information here. And whether the provision of second provision is applicable or not applicable, we are supposed to give. Now, what is this provision? Is the margin. I'm coming to it a little later as to how do you compute this margin. So now, question is, in which year do you report? Sometimes the agreement is done in year 1, but the sales are recognized in subsequent year. It happens, builders cases. Now, they generally do the booking in initial stage, where the agreement is, registered with the buyer, because the buyer is booking the flat and he secures the price. Now, the price will not change. Now, that time only the land is there. There is only some plinth work is going on. The building is not even ready. The building may take 4 or 5 years to get completed. So he makes the booking and then he pays across over a period of time. So now sale cannot be recognized by the builder immediately, because when the work is done, then only the sale is recognized as percentage completion. So initially, when the agreement is done, no sale is recognized, but probably in subsequent years, sale is recognized, but there is no agreement. It is possible. So we have to report this in the year in which the agreement is registered, because it is that year that the title is transferred. That is the year in which the customer gets title into the property, and then the title is frozen. That neither the builder can change the price nor the customer can change it. So this is where which year you have to mention. The sales might be in subsequent year also. Now I will explain you as to what is the method of, and now what happens to development right, leasehold rights, TDR, FSI. All these are various offshoots of land. These are all rights arising out of land. The wording under the section 43CA 50C is basically land and building. It does not say rights arising out of. It's a debatable issue. There is no clarity on this. But what is the common sense understanding is, when you are talking about land and building, it should be per se land and building, and somewhere else land and building specifically means land and building. Even for the purpose of your GST, they say that land and building and rights to the land and building are totally different. You cannot, because land and building is exempt under GST, whereas it is not exempt under in this TDR, FSI is not exempt under GST, because they say the right arising out of land are different and it is not exempt under GST. So similar view can be taken under this tax audit, that TDR, FSI, etc. would not form part of the land and building, which is a pure land and building and not rights arising out of, because there may not be any such ready reckoner rate for those kind of items. Now, how do you really work out this 10%? This is very, very interesting. Now, here you have to look at is the 10% of the agreement value. If it is increased, you will get a stamp duty value of 110. That means, suppose if you have done an agreement for rupees 100 and the stamp duty value is 110, then your consideration will be taken as 100 and not 110. But suppose if your agreement value is 100, but your stamp duty value is 111, then 111 will be taken as your sale value, not 100. So even if you have increased that thing by only 1 rupee, 1%, but still the entire 11 rupees will be added as an income. So you will lose the entire 10 rupee benefit and you will have to pay tax on that 11 rupees extra. So this is very interesting. Now, when you say 10%, you must look at it other way around. When you look at stamp duty value is suppose 100, the consideration cannot be lower than 90.91. Consideration cannot be 90. Now don't work out 10% that way. Consideration can be only 90.91 because 10% of 90.91 is 100. I mean 1.10%. So you will have 100. So if you add 10% on 90.9, you will get 100. If you add 10% on 90, you will get 99. You will not get 100. So you have to, your consideration cannot be 90 when your sale stamp duty value is 100. You should be very careful in that. People mix up this 10 rupees what? 10% is on what? It is not on stamp duty, but it is on the agreement value. That much you must understand, not the other way around. Now, depreciation is very simple. I am not taking much time on that because there are many other critical points which I want to discuss, but I will quickly take few minutes on this. One is that when you are working out a block method, you must understand that any input credit which you have availed on that particular asset, some of your plant and machinery, if you have availed any input credit, you must deduct input credit from the cost. And you cannot claim both. You cannot claim depreciation on that gross value and also claim input credit. That means, for example, suppose if you have purchased the plant and machinery for 118, and 18 rupees is the GST on that. So your actual cost is 100 rupees. So you will get depreciation only on 100 and not 118. You have to deduct 18 rupees from the cost and 18 rupees you claim input credit in your GST return, that is fine. But as far as appreciation is concerned, it is on 100 rupees, not 118 rupees. Then there are exchange rates which you have to apply. Subsidy or grant which is received for that particular plant has to be deducted from that block. And you have to work out depreciation is what is allowable. And that depreciation allowable has to be verified. Various blocks which are there. It cannot be a wrong block. Suppose if the residential building cannot go in commercial building and commercial flat cannot go in residential because the rates are different. And you must also understand that when you sell an asset, that asset, the sale value has to be reduced. We generally do work out the cost and profit for our books. But when it comes to block method, it is only the sale value has to be reduced from the block. And if the block after, suppose for example, you have a block of 2 buildings and the block opening WDV was, let's say, 1 crore rupees. You have sold one building out of that for, let's say, 90 lakh rupees. So you have got 10 lakh rupees carried forward. Now, yes, one building is sold, one building still continues. So then 10 lakh, you will continue to get depreciation. Suppose you had only one building for 1 crore and you have sold it for 90 lakhs. The 10 lakhs, you will not get depreciation. 10 lakhs will go to as a short-term capital loss in the book, because if the block is empty, you cannot carry forward. Another thing, suppose if you have got 1 crore as the block and you have got 2 buildings, 1 crore 20, you sell one building. Your block has become negative. 20 lakhs you will have to offer as a short-term capital gain, and that no depreciation further can continue, although one building still remains in the block, but that block is now over. So this is how it will work out. And first of all, there is no option here to say that no depreciation to be claimed. The wording in the income tax is very clear, shall allow depreciation. So you have got to compulsorily you have to claim depreciation. So if the assessee may say that no, I will not claim depreciation, I don't want to work out, then the qualification which you say that he has not worked out, and actually you cannot check. Now, put to use, yes, before we go into it, put to use is a very important term. In income tax, the depreciation starts only after it is put to use, whereas in our books of accounts, our AS10, it is when the asset is ready for its intended use. So there is a difference in the books and difference in the Income Tax Act. So you have to find out as to when it was put to use. There are lots of ways in which you can find out, because it is very difficult to find out when an asset has been put to use, because it is a subjective thing also sometimes. Building is ready, it is ready for its intended purpose. Depreciation starts under the books as per book, but it is not occupied, it is not used. So you cannot claim depreciation. A plant ready, but no commercial production has happened. Now commercial production happens, no sales, doesn't matter. Production should start, and it is put to use, then you can claim depreciation. It doesn't matter whether the sales are happening or not. Goodwill does not qualify for depreciation. Now earlier goodwill was being depreciated. Now you will not get depreciation on goodwill. Then these are clauses 35, 32, and all that. These are the sections which gives you exemptions, gives you deductions over and above whatever. Now, of course, the trend is that the exemptions are eliminated. There is an option to the company that you don't claim exemptions, but then you get a lower rate of interest, a lower rate of tax, that is 26%. Otherwise, if you want to claim all these deductions, then you go for 30% tax rate. So many people will find that, okay, why get into all this headache of claiming deductions and all? Better to claim 26%. They will have to evaluate whether which is beneficial. If the 26% rate is beneficial, then they will forget about all this deduction, and they will go for a flat 26% rate. And then at that stage, you cannot claim this deduction, because in your 3CD, then you cannot show this deduction, because it will contradict what you are doing. If you have initially you mentioned 115 BAB, and in that situation, if you are claiming this, then it is contradictory to that, because you cannot claim this deduction. Of course, earlier there was weighted average allowed, 125, 150% in some cases. Now they have brought it down to 100%, no weighted deduction. In some cases, capital expenditure also is being allowed as a deduction. In some cases, where they want to give incentive to research and all that, so they allow this capital expenditure as 100% deduction. These are all the various sections. The slides will be available. I would request if the CPE council can circulate. I mean, it is at their discretion whether they want to do it. From my side, I have no issue. Now, this is the employee payments. Employee payments basically have this clause 20 has got two sub clauses. One is relating to employee as bonus or commission. Now, this is very interesting, and I would like to spend some time on this. What is a bonus or commission? Whether the same is payable as profit from or dividend. Now, you all know that dividend has got a double tax implication. Suppose a company, a private limited company, has got 100 rupees of profit. First, it pays the tax, whatever 26 or 30, whichever is applicable, right? It pays the tax. Then, whatever is left out, on that, it declares dividend to its shareholders. There is no deduction to the company for this dividend because it is not an expense for the company, but it is getting tax in the hands of the shareholder. Earlier, there was no tax, there was a DDT and all that, but now that is gone. The tax is paid in the hands of the shareholder. Effective tax put together, company and the shareholder on the same income of 100 rupees would constitute around at least 50 to 60% of the total 100 rupees. Now, many entities don't want to pay this double taxation. So what they do is, there are shareholders who are like family. They are also directors of the company. Mr. X and Mrs. Y are the shareholders as well as they are the directors in the company. In mainly closely held companies, a similar situation happens. Now, what they do is, they will, instead of paying dividend, they will pay them as a bonus or commission. So what happens in this bonus or commission? Although it is taxed in the hands of the recipient, the shareholder, but still it is deductible in the hands of the company. So there is no double tax. So this is what, to avoid this double tax, people were following this principle, and then the income tax has become smarter. So they have bought this particular section. What it says is that if this particular payment is deemed to be in lieu of the profit or dividend, then it will be disallowed to the company. It will not get as a deduction. It's a bonus or commission. And of course, it will be taxed in the hands of the shareholder because he is to offer that income. But as far as the company is concerned, this deduction will not be available. Now, in that situation, how do you determine? Sometimes it could be a genuine bonus or commission because that person is actually working in the organization. Here, when this planning is done, basically those people may not be working. They are just passive, part shareholders, and they are getting this bonus or commission. But if they are actually working in the organization, but they are getting payment for the services they are rendering, then in that situation, this particular clause cannot come because it is not paid in lieu of the bonus, profit, or dividend. If they would not have worked, they would not have got it. Just because they are shareholder, they are not getting it. That is very important. And you have to prove by way of documentation as to whether it is really a bonus or commission or it is in lieu of bonus or it is in a garb of bonus or commission, it is dividend being paid. So that differentiation is very, very subjective, and you have to have a very high level of documentation to substantiate that, yes, no, this is basically a commission in genuine nature and it is to be allowed as a dividend. The next one is the sum received from employees as a contribution. Now, 43B into bracket B disallows certain contribution which is received from the employee. Now, that, see, when you collect something from an employee, it's like a TDS, like how we deduct TDS. It is like a deduction from the employee's payment, and you pay to the government. So it is basically not your expenditure. So artificially, deeming provision has been introduced, and that whatever you collect is being deemed as an income under section 224(10), and whatever will be that same amount you will get as a deduction, provided you make the payment on the due date. If you miss the due date, if you pay after 1 day, the deduction is gone forever. You will not get, suppose if you make the payment on, suppose you're due on 15th of September and you make the payment on 16th September, you will lose the deduction forever. You will not get deduction subsequently. So it is a very serious section, and we have to be very stringent that how we have to comply with this particular. So what are we supposed to report as a tax auditor? What is the month? What is the amount of contribution which has been collected from the employees, which is deemed income, and what is the payment due date, and what is the date of actual payment? And actual payment, we have to see, verify the challans. What is the challan when they have actually made the payment? Due date, we can come to know from the various acts, and we have to verify that and see that this thing is properly checked. And we are not supposed to compute a disallowance because the officer will compute, and even the CPC has got a system of computing this disallowance. Now, we will look at certain disallowances, which is clause number 21. capital expenditure, personal expenditure, advertisement, and earlier there was some disallowance on advertisement and expenditure, which is now removed, but the disallowance on the personal expense was very, very serious. How do you really determine? There are sometimes very, gray areas, whether it is personal or not, it's a business decision. For example, I'll give you a very simple example. Suppose there is a CEO of a company, or an MD of a company, who is a very senior person, who is, let's say, is about 70 years of age. But his contribution to the company is immense. Because of him, the company is making profits, is getting the sales. And suppose if he is required to visit some foreign country for meeting some customers or attending some meetings for the business of the company. Now, there is a genuine business requirement and he has to attend. There is no doubt about it. And that his expenditure is genuinely 100% business expenditure. But now, because of his age, he's 70 years of age and he's got medical conditions, he's got various heart issues and all that. He requires somebody to accompany him and his wife accompany him for the purpose of his safety or for his health. Now, in that situation, whether the wife's expenditure can be considered as a personal expense or business expenditure is a question mark. Naturally, first thought you will say, oh, it is a personal expenditure, or what is the reason why the wife has to go? Wife has nothing to do with business. But no, wife had to go because that person would not in a position to go to that conference alone. And if he would not go to the conference or that meeting alone, the company would lose some money. And that is the reason it would tantamount to a business expenditure. Now, this is again has to be properly documented, has to be validated by some health certificate or the doctor's certificate. And no, he cannot go alone, he cannot travel alone. And he has attended those business conference only for the company's business. And he has not gone on a holiday. All this has to be established thoroughly. So it requires a lot of documentation to establish that yes, this is not a personal expense in a business expenditure on a case-to-case basis. There is no general rule or law, but there are certain judgments what I'm talking about is out of some judgments. This judgment has allowed the deduction because there was a requirement. The family had to accompany the person just for the sake of his health. Then there are in additional under section 40A. 40A has got various sub-clauses. As I said, there are so many questions. Now, first of them is the into bracket small one, which is basically payments to a non-resident. Again, you are a very critical matter. Payment to a non-resident triggers TDS under section 195. 195 is a very wide term. It is not a simple like professional fees or interest, any payment to a non-resident. So the very wide, like for example, if you have remitted any money outside India for some services rendered outside India, royalty, or it could be even buying shares of the company, then also there is a 195 applies. So various sections are there, 195, and for that there is a requirement from the bank that before when you remit the money, you will have to submit one form 15C and 15CB. Of course, 15C, 15CB has been relaxed in some cases where the transaction amounts are small. But here I'm talking about large transactions where 15CA, 15CB is compulsory. Now, 15CA is basically prepared by the entity, by the assessee, by the company prepares the 15CA. And 15CBA, they get it certified by any independent chartered accountant. Now, a chartered accountant will certify 15CB. And he will certify, what he will certify is basically he will say what rate of tax to be deducted. Now, section 90 of the Income Tax Act gives you some relaxation under DTA. If that income is taxable in both the countries, for example, if you are making payment to a Singapore, then certain income is considered. Like for example, you have retained an architect from a Singapore to do your project. Now, architect is giving you drawings from Singapore. Now, whether the income accrues in Singapore or income accrues in India. So now payment is made, 195 applies. So you have to, the DTA says in certain cases, the tax is payable in Singapore. So no TDS is required to be deducted. So he gives a certificate in 15CB that no TDS is required to be deducted. And accordingly, the assessee will not deduct tax and the bank will allow it to make the payment outside India without payment of tax. Now, there is one very interesting concept I would like to share with you, not really relevant for tax audit, but for our common sense. There is something called make available concept under DTA. Now, what is make available? The person who is rendering service from Singapore, that income can be taxed in India, if he is giving you make available technology in India. That means, see, suppose as architect is making a drawing, a design, and giving you in India. Now he's only giving you a drawing. Now you, from tomorrow onwards, you can't start making drawings. You can use his drawings for making a building. That's it. But you cannot start making drawings for some another building based on that drawing. You cannot be, because is his intelligence, what he has got, that he has not passed it on to you. His knowledge he has not passed it on to you. What he has passed it on to his work. So he has not made available to you the technology. What he has made available is the work. So the DTA says, if that make available is not there, the taxability is in Singapore. But if the make available is there, then that income accrues in India. That means he has given you the full technology transfer. Then the income accrues in India, and you are required to deduct tax at 10% or whatever rate applicable as per the DTA or as per 195, whichever section 9, whichever is lower, beneficial, because the DTA says whichever is beneficial you apply. So even if suppose your rate in the Income Tax Act is 30% or 40% sometimes, and if the DTA says 10%, you apply 10% rate. So this is how you have to work out, and that becomes the basis on which whether the compliance is done on 40A1 or no. If in case if the 15 CB says 10% or nil rate, and if they have not deducted or if they have deducted 10%, even though Income Tax Act says 40%, then there is no violation under 40A1. Now 40A1A. 40A1A talks about payments to residents. Payments to residents is section 194 and all those sections like interest or royalty, professional fees, rentals, and all those things which we are already aware. 194R, which I mentioned earlier, will also come into play. And we have to verify whether 194R TDS has been done. And I will spend some, let me first explain all this, and then I will go into 194R, because that is one of the most complex of the sections which has come into the play in entire TDS provisions. I will discuss with you. Now, what do you do in the case of the TDS on normal payments? We have to see whether the tax has been properly deducted, and if whether they have been paid within the deducted and paid. There will be two situations. One is when deducted and not paid, or not deducted. Then there is question of payment doesn't come, because if it is not deducted, where is the question of payment? So both the things will have to be reported. And similarly, with same case for the non-residents also. Now, in case of 40A1A, that is the local domestic payments, there is one very interesting provision I would like to share with you. This provision has been there in the Act earlier also, and I will explain you what that provision means. Now, if you go to section 201, there is a provision which says that in the event the tax is not deducted, hear me out very clearly. If the tax is not deducted, suppose for example, you were supposed to deduct 10% tax from, let's say, interest income. You have not deducted. Okay, you have paid the full amount to the assessor. To the pay. So you have not deducted. Now the person who has received the money gives you a certificate from a chartered accountant, his chartered accountant, saying that I have either paid the tax which is required on that income, and I have filed my return, number 2, and or there was no tax payable in my case because there was a loss and I was not required to pay the tax on that, and I have filed a return. So if this certificate is given by a chartered accountant of that payee, then the default on the TDS is not, and the assessee is not considered in default. There is of course a form to be filed with the Commissioner of Income Tax. You are supposed to submit whatever certificate you get from a chartered accountant. You are supposed to submit with the Commissioner of Income Tax of your range TDS, and then you are supposed to inform that is one procedure you have to follow. If you follow that procedure, then you are not assessee in default. No disallowance is triggered because of 48 money. So this amount does not require to be reported as a default, because the Act says you are not in default. So you are supposed to take. Now suppose in some cases the payee obtains a lower deduction certificate or a nil deduction certificate from the assessing officer, that is 197. And in that situation also, the rate then accordingly gets reduced to what has been prescribed by the income tax officer. So then there is no default. Suppose, for example, the 10% tax is applicable, but they have got a lower deduction at 0.5%. And if the associate, the associate has deducted tax at 0.5%, so there is no default. And there is no question of any reporting required. So this is very important. And now let me take you to 190. And then before we go to 194R, because it requires a few great amount of deliberation, I would like to explain you about FBT, wealth tax, and all that is not applicable now. So that is not required. And there are other small sections which is not really very important. So I will now straight away take you to one very interesting provision on 40B and 40BA. This is the 40B and 40BA is referring to our payment made to partners. As I mentioned earlier, any salary payment made to partners or even interest paid to partners, what is the requirement? It should be authorized by the deed of partnership. If you have to see whether it is authorized by the deed of partnership, yes, salary can be paid. It should be paid only to working partners. The working partners should be defined under the partnership deed. Then payment can be made only prospectively. You cannot have a retrospective. For example, if you have made a partnership deed amendment in, let's say, 1st of October, and then provided for salaries from 1st of October, and when you start making provision in the accounts from April, it cannot be allowed. For 6 months, you will not get deduction. Only when your partnership bid authorizes you from October onward, you will, or you in partnership bid, you can't mention that it is allowed from April. You can only provide for it only after the partnership bid is made, that is in October. And so your salary will start only from October. So your deductions for earlier period will not be allowed. And similarly, same question will be of interest, which is 12% rate. And 40B is there is certain percentage of on the book profits up to 60% you can get. First 3 lakhs is 90%, and there is a 1.5 lakh that minimum limit is there. And then we have got about 3 lakh is about 60%. So this limit has to be again mentioned in the method of computation should be mentioned in the deed also. You cannot just say, okay, some salary will be paid. No, that cannot happen. It has to be mentioned what salary also has to be paid. Now, disallowance, deemed disallowance under 48.3. Now, 48.3 basically trying to curb cash payment. As I said initially also, the government wants to curb as far as possible banking transaction. They want to encourage banking transaction. They want to curb cash payments. Because in cash payments, it is a general belief that there is a manipulation and people can put in vouchers or something which later on backdated and can claim expenses. Whereas in case of a check payment, there is an evidence. Now, when this 48.3 was introduced long time back, it was only 48.3, which says that any payment made in cash about 10,000 rupees will be disallowed. People were very smart. They start using their minds, fertile minds, and they say, okay, fine. March 23, they will make a provision of 20,000 in the accounts. Naturally, no payment is made, so no disallowance can happen because it is only liability provided in the books. So deduction can be claimed. Subsequent year, April, out of that liability which is provided in 31st March, they make the payment in cash, 20,000 rupees. The second year, they will say, look, I have paid in cash, but I have not claimed deduction in the second year, so you cannot disallow. So the department had a problem and certain judgments went against the department. So now they overruled that particular judgment and they brought in another section called 48.3A. Now, what does 48.3 says? Even though you have made a provision on 31st March, and if you make the payment subsequently, it will be disallowed in the subsequent year when the cash payment is made. So then they got an enabling provision that I will disallow this particular expenditure. Then, of course, gratuity and the other payments are already considered under 43B. So there might be a double accounting, but you have to mention that in the notes that it is double. 14A basically is now got diluted after the dividend is become taxable. So any investment in shares does not attract any 14A. Earlier, shares was the major component and 14A was applicable. Now only partnership investment remains. And if you invested in partnership, then 14A applies. 14A basically talks about any tax-free income you are receiving, and if you have invested for that, then interest is disallowed. And of course, not only interest, but there is also certain percentage of your overheads, expenses also get disallowed. 36.13 is very interesting. I mentioned when I was discussing depreciation that put to use. in the Income Tax Act, the concept is put to use. Our A16, which is the borrowing cost, what does it say? That you start capitalizing interest on a qualifying asset. Now, qualifying asset here in A16 talks about 12-month period. If an asset takes 12 months or more, then it is a qualifying asset. Otherwise, it is not a qualifying asset. In case of, then if it is more than 12 months, then you have to capitalize interest and then stop capitalization when that, asset is ready for its intended use. In case of 36(1)(3), it talks about capital asset. And there is no question of any qualifying asset, but the 12-month period is not applicable. I'll give you a simple example. Suppose you are importing one machine from outside India, 1 crore rupees, and you have borrowed money for that because you don't have money. You have borrowed 1 crore and you have paid in advance to that supplier. Supplier is shipping that material. It will take 2 to 3 months for the material that's planned to get ready to ship to India. And after 3 months, maybe 1 month to install. So ultimately, after 4 months of the advance, the machine gets installed. Now, under A16, there will be no capitalization because it is not a qualifying asset. It is less than 12 months. So it will be debited to profit and loss account. But here 36(1) says, from the day you gave advance till the day asset is put to use, not ready for intended use, put to use, that plant is put to use, till that time, whatever interest you paid will be disallowed. So you have to mention this figure in this particular clause 21 to ensure that the disallowance will happen for this particular section. Now, 40A1A, whether, see, this is again a debatable issue. There is no certainty on this. There is an ITAT, Mumbai ITAT judgment on this. If suppose, for example, instead of deducting 10%, the assessee has deducted 2% on that some matter, whether the amount will be disallowed or not disallowed or proportionately disallowed. There is no such thing like proportionate disallowance. So Mumbai ITAT says no disallowance unless it is fully, they have not deducted only, or they have deducted not paid. Only if this condition happens, then only you apply this. So in that situation, there is of course ITAT judgment. This will be tested by Supreme Court and it will take time. So till the time it is reach a finality, very difficult to say which way it will go. Now let's discuss 194R, because I'm also just seeing my time also is 6:30. I've got another half an hour, but I will try to complete because there are so many other major sections, major items remaining. I would like to cover those also. So 194R. 194R has been recently introduced and it is applicable for assessment year 23-24. It was introduced by Finance Act 22 and it was supposed to be implemented from it was in fact implemented from 1st of July 22. That means for 22-23 financial year, it is definitely applicable. You know one thing, there are so many sections in the income tax. This is the only section where before even it was implemented, that is from 1st of July, in month of June, we received one circular clarifying this section. Again, there was another clarification which we received somewhere in September or October saying the second clarification. Now, generally, we believe that when there is a clarification of circulars or in the nature of circulars, these are binding on the department, but that may not be binding on the assessee unless it is beneficial to the assessee. That is general belief. But this particular circulars are binding on both. And what is authority? The section itself mentions this. The section in 194R 2 and 3 says, subsection 2 and 3 says that these circulars, when they will be issued by CBDT, will be placed before the House of Parliament, and then it will be approved by the Parliament. Generally, circulars are not approved by the Parliament. It is issued by CBDT as a matter of administrative convenience. But here, since it is approved by the House of Parliament, Lok Sabha, it gets a character of a statute and it becomes binding nature. And this circulars, what it says, very, very interesting. There are so many things they have clarified. I cannot go into the entire day because we need 194R will require 2 hours of deliberation, because I have taken a lecture on 194R for almost about 2 hours. And it is very interesting. I'll just give you the brief of it, and you can labor it on. You can read those two circulars, and you will get an idea. In normal situation, what happens when a person deducts tax? He is supposed to make the payment within the next 7th of the next month, and he has to file a return and show it. But it is very simple. But in 194, it is not that. When you are providing a benefit, even before you have provided the benefit or on the day of providing benefit, you have to pay tax. You don't have that extra time limit for 1 month. Suppose for example, you have provided a benefit to some businessman on 1st of let's say August 2022. You are required to make payment of tax on or before 1st of August 2022. You cannot get the credit of 7th of September, which you get in the normal situation. So this is one thing. Secondly, when a benefit has been given, for example, you have booked the assessee has booked a ticket or hotel for some giving benefit to some marketing guy and incentive. Now, TDS generally, when we say 10, it's a 10% rate is there. That means, suppose if you have given a benefit of, let's say, 5 lakh rupees. So you would have ideally thought about deduct 50,000 and pay. But from where you will deduct? You're not going to deduct anything. You're not making payment to that person. You are only making expenditure. So you're not going to deduct 10% from that hotel wala or from that airline wala. No, he will not allow you. This 10% benefit is going to the tax is going to that person and not to this hotel or airline. So that 10% will be crossed up. Whatever payment is made by the company to those hotel or airline will be considered as 90% and we'll work out what is 100% and then pay 10%. So it may not be 10, it may be 11. I mean, it is arithmetic. Now here, this is the only section of TDS where tax can be paid by the payee, by the recipient of the benefit. For example, suppose if the company has provided some benefit to the marketing guy who is doing some marketing for them, and he has given some tickets and hotel booking and all that for foreign trip. Now the choice is that either the company pays process up and pays tax on that, or the person who receives the benefit can pay 10%. Now in that situation it will be only 10%. There is no question of grossing up. Suppose if he is getting the benefit of 5 lakhs, then the TDS will be 50,000. Whereas in the case of company, that 5 lakh will be 90, so it will not be 50, but it will be 55,000 or more. I mean, exact working we can do it. It will be something around more than 50. Whereas if the recipient of the benefit is making the payment of tax, it will be 10%, 50,000, because the company is not incurring extra expenditure. He is incurring the expenditure because for him this is a benefit. Now, how he has to make the payment? He can make the payment and he has to give that challan to the company. Company will then reflect the challan in his TDS return and submit to the government. Now the challan can be an advance tax challan also, but he has to give some particular form based on which he can get the credit for this TDS return. So it's a very complex thing. Another thing very complex. Of course, they have defined what is box. Suppose if you have conducted a seminar where you have invited all your marketing persons, marketing reps, and that marketing reps are without any basis whether you have achieved some targets or no, then there is no question of course. Because if that particular conference is to train for the product, or if there is any how the marketing is to be done, what are the product benefits, if you are doing that conference for that, and if you are inviting all your marketing reps, not an employee, this doesn't apply to employees because it is employees 192 applies other than employees. So it is a business TDS. So then there is no question of any TDS. Now, suppose as an auditor, I am sending my team to a client's place for audit. Suppose there is an outstation audit and my team goes outside station. There are two choices. One, the company would provide for accommodation, would book accommodation and transport and all that. Or then there is, in that situation, there is no question of the chartered accountant firm claiming reimbursement. But suppose if I incur expenditure of travel and hotel for my staff who stays there for doing the audit, naturally, I am going to subsequently, when they come back and they give me bills, I am going to claim this expenditure as a reimbursement from the company by raising a debit note and say, okay, this is what I've incurred, please give me the money. Now, if the bills, naturally those bills will be in my name because I have made the booking. The company is not in picture. If the bills are in my name, the person who is claiming the reimbursement is in his name, then 194R triggers and he has to deduct TDS. The company has to deduct TDS from that payment of reimbursement, which earlier the reimbursements were not liable for TDS because it is not an income for me. It is basically a reimbursement I have spent for which you are giving me money. So it is not that I'm earning anything out of it. So in that situation, TDS will be deducted. Of course, I can claim that as in my return. But then what happens is the moment 194R is seen by the assessing officer, it triggers in his mind. Look, there is some benefit. Now he will try to invoke section 28 because 28 says that there is a benefit taxation. But here in my case, it will be a reimbursement. So there is no question of 28. Yes, if I have gone on a holiday by the sponsored by a customer, then yes, then that triggers section 28 because then the benefit comes into it. So these are this 194 R which comes into play. I've already explained this why. There is one very interesting amendment which has come, which is amendment from last year. That is even it is applicable for March 23, which we are auditing now. Section 9 explanation 2A, significant economic presence. See, we all know that any import of goods, there was no TDS. Earlier, we knew that. Import of services, yes, that I said, there is that 195 where you have to apply DTA and all that, and you to deduct tax. But as far as import of goods, there are crores and crores of goods which is being imported to this country. No TDS was applicable. But now with this explanation 9, section 2A, significant economic presence has been introduced, and which that any person outside India selling goods to India more than 2 crores to from one person selling to another person, 1 person, 2 crores or more. It amounts to that there is a significant presence in India, and TDS rate is 40%. The concept is that taxability is of that on that 2 crore, whatever is the income earned in India is taxable in India. That is what they have tried to bring in by section 9. Section 9 is the income accrued in India. That is the section. And in that they said, okay, if that particular trigger, then under 195, you will have to apply 40% TDS rate. Now, 40% TDS rate on a 2 crore sales where his profit may not be high, anything, maybe 5% profit, but still you will have to incur to 40%. So how do you save this? You will have to, that company will have to apply for a lower deduction in this, to the income tax officer and say, look, I don't make 40% profit. You look my P&L account. And you will have to produce all this to the income tax officer, satisfy him that no, I don't make so much of profit. Maybe then he might give a lower deduction of 1% or 2% or whatever. That depends on the assessing officer, and then that tax has to be applied. But as a rule, suppose if it doesn't provide this lower deduction, 40% TDS is applicable. So you have to be very careful in this section because this is a hidden addition which has been made in the section 9(2). Okay, now we go to this 48(2)B, related parties as far as AS18, which is applicable. AS18 is there for our Companies Act, accounting standards, but income tax has got 48(2)B, which is a related party. And the sections which are defined here, 48(2)B, are very complex. If you go to the 6 subsections in that 48(2)B, you will be amazed that it's very difficult to compute who are the related parties. For simplicity's sake, I have made one chart, and this chart basically helps my team in computing who are 48(2)B parties and to verifying that where are 48(2)B parties. First of all, the assessee is supposed to give the list, and we are supposed to verify. Now, let's just explain you this list in short, because time is short, and I have to cover some more very important sections. Assessee is shown in the middle. That is a company, firm, or AOP or HUF. There are 2 sides of that assessee. One side is where he is being on what is invested. Suppose anybody who is invested in this company, like who are the shareholders, who are the significant shareholders, 20% or more. That will be first point. And if the assessee has invested more than 20% in another entity, so those entities are also on the right side. So I have tried to break into 2 parts. One is the left side, which is all the people who are invested in the assessee, and the right side shows what in which the assessee is invested. Now you look at one side. I will take you to this left side here, entity. This entity, if you see, now take these people who are D, P, and M, which I have mentioned here. They are the Mr. X, Mr. Y, or Mr. Z. These Mr. X, Mr. Y, or Mr. Z are either holding 20% or more in this assessee company. Okay. So first you have to see that whether they are holding more than 20. Who are holding more than 20? That you have to see. Now, if that person, Mr. X, is holding 20% or more, whether he's a director in any other company, how many companies is a director? First find out that. If he's a director in one company, let's say, then find out that first of all, that entity in which he's a director will be covered 48 straight away. That person who is holding 20% definitely is covered, and his relatives are also covered. Now the entity in which his director will be covered. Now the other directors of that entity also will be covered, and their relatives also will be covered. Suppose, for example, Mr. X is a director of one ABC Private Limited. So that ABC Private Limited is covered. Mr. X is covered. Mr. X relative is covered, and that XYZ ABC Private Limited's other directors who are other than this Mr. X will also be covered, and their relatives also will be. So it is a very wide. Now, let's say there is a company who has invested into this assessee, for example, or who is holding shares in this company more than 20%. Suppose there is a XYZ Private Limited company owning shares in this our assessee. Okay. Now is more than 20%. That means significant influence is there. Now that XYZ Private Limited, which is holding 20%, is holding 20% in some another company. Let's say ABC Private Limited. That ABC Private Limited also will be. So this is a very wide term of this 48(2)(b). And if you miss out that, then you are violating 48(2). So you should always be very careful how you determine this, and check this chart. I mean, this chart is available for you now to use it, and you can. And this has been tested since almost about 12 to 13 years. I've been using this, and there has been never a mistake which we have found out, because I have mentioned even if you see there are subsection numbers also mentioned 5, 5, 4, 3 and 4, which is relevant subsections of the 48(2)(b) under which clause which I have worked out. So this is I have myself prepared this, and my office has been using this in so many years, and not a single mistakes has been located in this particular chart. So I would encourage upon you to use this chart. It will help you out in identifying and working out this 48(2)(b) parties. So it will make your life simple. Now again, what is 48(2)(b) payment? Now what are we supposed to say in this 48(2)(b)? The name of the parties. You're supposed to see the transaction nature of the transaction and the quantum amount. Basically this particular thing is identified for the officer to go into arm's length, whether these transactions are at arm's length, because it is assumed when your transactions are with a related party, there might be some adjustments in the pricing. You have an option of manipulating the price, but we are, as an auditor, we are not supposed to get into arm's length pricing. We have to only report what is the quantum and what is the name and nature of the transaction and relation. This is what you're supposed to mention. Now, if the assessing officer, based on this, can ask during scrutiny, he will ask the assessee, okay, you explain now how it is arm's length. So that they have to prove that whether it is arm's length or not arm's length. And if they cannot prove, then it will be an addition to be made. Now again, what is to be reported here? No income is to be reported. Like in AS 18, we are supposed to report income, loans, everything, balances. Here, what we are supposed to report is only the expenditure, and expenditure in terms of revenue expenditure, not even a capital expenditure. So which is what, because 48(2)(a) starts with that, it is an expenditure. So even the word payment relates to expenditure and not any check payments. It is basically expenditure. Now, this is a deemed income which comes out of the deductions which were claimed by the assessee in some earlier years, but because of some non-compliances, there is a deeming income. Suppose you had got some deduction under Section 35, and then you had got capital expenditure the reduction, and then you sell that asset within some time limit, which is not allowed. Then it becomes a deemed income. So that is the clause here which we are supposed to report the income. 43(b). Initially, it started with a statutory liability. Now, statutory liabilities, government want to discourage non-payment of statutory liabilities. They want money. So they said, okay, if you don't make the payment, we will not give you reductions. They started with all statutory liabilities. Then slowly they started adding various other items like interest. Now there is even payments to railway for if you have hired something on railway platform, some stall and all something, and if rent is not paid, it will attract disallowance under 43(b). Disallowance, it will be allowed as a deduction only when you make the payment. Yes. Now when we were discussing on a lighter side, when we were discussing with various CCMs and committees to, deliberate on various topics, I had, mentioned on a very lighter mood. Okay, why don't we even request the government, or we make a representation to the government or to the finance ministry that you please include audit fees also as 43B, because we, at least then we will get our fees immediately on time and people will start making payment. So of course that never happened, but they have modified and added some few things which I would like to share with you, and which is very, very serious, like MSME. Any payments made, for this is applicable from assessment year 24-25, that is from the current year, financial year, that is April 23 to 24. This particular section is applicable. Now MSME, there is, under MSME Act, a supplier who is a MSME will be required to be paid within 45 days. If you don't make the payment within 45 days, you have to pay interest, and there are some other strictures in the MSME Act. So now they have brought it out in even 43B that if you don't make the payment within 45 days and if you pay subsequently, then the deductions will be allowed in the next assessment year. Even that allowing the deduction within the time frame of return filing also is not there. Suppose, for example, you had to pay something in March and you have missed out, and you pay even before filing of return, that deduction will not be allowed before the in that assessment year. You will get deduction in the subsequent assessment year. So that is the seriousness of it. So you will lose deduction in the 1 year and you will get deduction only in the subsequent year. And then there is one more thing, is that there is one very interesting word: interest paid to systematically important non-deposit taking non-banking financial company. A very big name. By the time you finish the name, people go to sleep. What is systematically important? Systematically important is those companies who's got assets more than 500 crores. That is one condition. Second condition is that although it is an NBFC, it does not accept deposit. So it gets capital contribution or whatever source of funds, but which is not deposit. So there is no deposit. But it is an NBFC. If all these conditions are there, and if any interest is payable to that particular entity, then 43B applies. Any interest which is paid has to be first paid, then only you get deduction, otherwise you will not get deduction. So there's an incentive for those entities to get paid. Deemed gift 56-7 is not applicable. I'm skipping it because it has been the sunset clause, assessment at 22-23 onwards, it is gone. Now 56-7B is to curb black money. Why? Because black money. Because what people used to do, in the garb of share capital, they used to bring in money, unaccounted money, and maybe some kind of a consideration being paid in cash, and they will receive the money in the company, and it remains in the capital form in the company, and no tax is being paid on that income, that money. So they said, okay, look, we will allow you share capital at the fair value up to the fair value of the company. Suppose if the company's fair value is 110 rupees, you can, if the share is of 10 rupee, face value, you can have a premium of 100. That means you can allot the shares at 110. You cannot, if the moment you allot the shares 120, at 10 rupees excess will be taxed in your company's hands. So, and they had exempted the non-resident from this. That means if you get a foreign FDI, then that was exempt, because RBI is controlling any case FDI. But they said no, from assessment year 24-25, even non-resident is also covered. So they are also not spared. So now if the shares are allotted at par, you don't even have to look at this section. Don't even, because it is at par. Only when you work out premium, then you have to see the fair value. Now, how to compute fair value? There were two methods. One method is the discounted cash flow method, where you take the profits of the next 5 years and discount it to current and work out the value. Or the other is 11UA. 11UA is a book value method. Book value is basically all the assets at the stamp duty value, and that is to be worked out. Okay. So that forfeiture. This again was brought in to curb black money, because many people used to take money as a check, as an advance for sell of flat and forfeit it. And basically it is nothing but some kind of a cash entry where nothing is payable to that person. He gives you a check and you don't have to pay back, but you are paid back in some another manner. So now you don't have to pay back in check, so you forfeit that money. And what they should do, suppose for example somebody has a flat which where he's staying and he doesn't want to sell, he's not going to sell the flat forever. So what he will do is he will take some advance. Let's say he's got a flat worth 1 crore rupees. He will take some advance of 10 lakhs by way of check, not thinking of making any payment, and he will forfeit it later on and deduct from the cost of the asset, which will remain in his books. he doesn't have to pay tax. Only when he sells, he will have to pay tax. So that has been plugged now after this section has been brought in, which now if you get this forfeiture, then in the year of forfeiture, this income of 10 lakh will be tax in your hands, and you don't wait for the cost to be reviewed. Okay, 56 to 10 is a very wide section. I think time is very short. I have only about 4-5 minutes. So only thing I would like to say is that this is a deemed gift. When when you sell something, there is a tax, we can understand. But here, when you purchase something at a discount, when you buy something which is lower than the market value, then you pay tax. It is something very surprising. But yes, what is trying to say is that actually you're not got a discount, but basically you have paid something in cash. So that is the reason they're trying to bring in a deemed gift provision. Now it applies to immovable properties, it applies to shares, it applies to various things. Now it does not cover partnerships, share of partnership. Suppose, for example, if you are a partner and you are retiring from partner and somebody buys your shares, then that 56 to 10 doesn't apply. But of course, there are other sections, 45(4) and all that, but we are not getting into that. Okay. So I'm just quickly rushing through this because time is short. I'm sure, can I get about 4-5 minutes extra? Or should I finish by 7?
Yes, sir, you continue.
Okay, thank you so much. Now, this is very interesting section 92C. 92C is basically all transfer pricing. Whenever any transaction is done with a foreign enterprise, which is an associated enterprise, which is holding 26% or so, or you are having 26% or so share, or there is some transaction as such that it's so structured that it amounts to an associated enterprise, then any pricing, any sales or purchase which is done between these two parties are monitored for the arm's length. And there is a separate 3CEB report which is filed by an auditor with the income tax department to certify that yes, this transaction is at arm's length. In 48OB, you don't certify arm's length price, but yes, here you certify arm's length. In this situation, what happens if there is a primary adjustment being made so moto by the assessee, or the department has worked out something under advanced pricing mechanism? In that situation, and if you have already billed, let's say at 1 crore rupees, as per the arm's length price, it is 1 crore 10, that 10,000 has to be, 10 lakhs has to be recovered from that customer. And if you don't recover this 10 lakh from a customer, there is an imputed interest. Now see, in income tax, there is no other section except this where interest is imputed. Imputed matlab, suppose, for example, I give interest-free loan to somebody and I don't have an interest cost. Income tax department cannot say that assumed interest because you have given interest-free loan, so there will be an income on your hands and we will charge you tax on that. No, they cannot. Unless I receive interest, unless interest accrues, there cannot be any tax on it. But in this situation, unless if I have got an interest expense, then there will be some disallowance. That is a different issue. But if I don't have an interest expense, there cannot be any tax. But this is the only section where there is an imputed interest. When there is money to be received and you don't receive it in some time frame of 90 days, that that interest is imputed, and that imputed interest will be taxable in your hands. Then there is a 94B1. 94B1 talks about see what again, this is again structuring and planning. See, what the income tax department has found out is from our own structuring and planning, which is being done by the assessees, they gather data, they gather information, intelligence, and based on that intelligence, they are trying to, plug those loopholes by amending the sections. So that is what has happened. What were people doing? Initially, the money used to come by your share capital if there is an investment required in the private limited company, because a huge amount of FDI has come into India from foreign, which is basically a FDI. Now, FDI permits money in either in capital or by way of a loan, ECB, allowed. Now, what people do is, they first bring in some small amount. Suppose if they bring in the entire amount as capital, what happens? They have to declare dividend to pay him, foreign company. And we already discussed that dividend has got double taxation impact. So if first the company pays tax on the difference on the profit, and on the dividend, again, that other company would pay tax. So there is a double tax. So there's a higher tax incidence. So what they do is, they will keep the capital component low. And the remaining, suppose if they are supposed to bring in 100 crores in the company, they will bring in only by way of 5 crores or 10 crores by way of capital. 90 crores will come as a loan, ECB. So on ECB, they will give interest, which will be deductible in the hands of the assessee, and they will be taxed. Okay, there is no double tax. And in some kind of DTA model, there is no tax for it. So that there also is a benefit. Now in that situation, The government says, no, we will not allow you blanket reduction of the interest. If the interest goes above 1 crore, then you have to verify whether it is more than 30% of EBITDA, their interest, or we will disallow excess of 30% or 1 crore, whichever is lower. So we will disallow that. So it is basically to curb that 90% of amount coming by way of a ECB. So they will balance it out properly. Now GAR. GAR is one of the most subjective thing which one has to understand. Even conversion of a private limited company to LLP can attract GAR. Why? How can it attract GAR? It's very simple. Private limited company has got results. When you want to liquidate, distributed dividend, again, as I said, double tax. So they say, okay, we will convert it into LLP. And when you convert to LLP, that profit, whatever is the reserves or capital account, can get be withdrawn by the partners without any tax. So double tax is not there. And in that situation, GAR can be invoked because that is the planning you have done to avoid tax. Now, sometimes planning may be not for tax one, but for commercial substance. So, but this tax saving is incidental. So there are judgments which says, you cannot just consider that because it is tax saving is there, it is the intention was tax saving. I'll give you an example. I had argued before a tribunal on one matter and successfully got it. There was one company which was having two undertakings, and they wanted to have two investors, separate investors for those two companies. Now, both the investors never wanted to come into the company because there were two projects, and the investor number one did not wanted to get into the second project, and similarly the second one. So now, how do we handle this? Okay, the only option was that they had to demerge that company into two different companies, and that demerged company will then have two different undertakings, and then they will have two investors separately. Now the investors said, no, we don't want to come into a company format because it's very complex and all that. We want to come into LLP format. So there was a condition. Now naturally that once the company is demerged, then they can do conversion to LLP. Now when all this was done through the process of NCLT and conversion was done, the department came out with a situation that there is a gap because you did all this just to avoid the dividend tax. Then we matter went to the assessing officer made an addition because the amount was huge. It was more than several thousands crore. So what they did, they went to the CIT appeal. Again, there was a problem. And then that also was confirmed in the favor of the department. We went to tribunal. Tribunal looked into it and said, okay, look, there is a commercial substance. Why did you do this? If I had not got this converted into LLP, if the assessee has not got it converted to LLP, the investors would not have brought in any money, and investors would not have come in. And if the investors would not have come into the company and brought money, then the probability is that the project would not have taken off. And project would not have taken off, the company would not have made money. So it was the intention was to get those investors in, get the money in so that the project is on, and not the intention to save tax. The saving of tax was incidental. So this is a very subjective aspects in GAR, which very difficult to prove at one point of time. Okay? So, but of course, we as an auditor, we cannot identify. Very difficult to identify. There is a threshold limit of 3 crore. And 3 crore applies to all the parties put together. How will you know what the other party? You are only auditing one party. How do you know about the other party? So I think a disclaimer of their opinion is much more better than the giving any opinion on that. Now there is 269 SS, 269 TR loans. I'm not getting into it, but there is one thing I would like to add, and it now include even sums received. Specified sum includes advances received for property sale. Suppose if there is a builder and he receives advances, that also is covered here. And 269 ST transactions are also covered. If you have got a capital contribution, the amount is 2 lakhs in that case, not 20,000, which is applicable for other cases. Now, it is also the other than loans, whatever it is, from the sales, or if it is any capital contribution, all that is also covered under 269 ST. We must be very careful. And of course, we have to give a disclaimer as far as the pays account check is concerned. The evidence is not in the possession of the assessee because you have not verified it. How can you verify it? The check has been issued. Now the check is with the bank. How can you know it is pays account or no? So you cannot reply. You have to say that it is we cannot verify, and we have no supporting evidence for that. Change in shareholding is section 79. If there is more than 51% shareholding, then the dividend, it is TDS compliance. I've already discussed in detail. We are supposed to give First column talks about the column where the whatever is the TDS on which you are supposed to do, TDS is applicable. Okay, so first column. The second column is TDS on which actually deductible. For example, there's a professional fee. Professional fees per se requires TDS, so it will come in column one. Column one. Now, suppose if the bill, one particular bill is less than 30,000, then TDS is not applicable. And if during the year there are no other transactions, there is no TDS. So in the second column, it will get eliminated. But in the first column, it will appear. Now, first column figures should match with your P&L account, but there could be advances. So that has to be added. So all that adjustment we have to do. Now, even purchases are covered. You know that there is the section which says purchase also TDS is applicable. This I've already discussed. Now, deemed dividend 222. Again, here this is again brought in to curb the menace of some planning. As I said, private limited companies, any payment out to the shareholder attracts dividend tax. So what people started doing, they wanted to avoid this dividend tax. So they said, okay, we will give you as a loan to the shareholder who is holding more than 10%. They said, okay, that is a deemed dividend, a loan considered as a deemed dividend in the hands of the shareholder. So 222 was introduced. It is long time back. Then people started using, again, making a further this. They said, okay, another company in which the shareholder is holding 20%, okay, you give a loan to that company. Don't give it to the shareholder. So that they plugged also. Okay, if 20% or above in another company, again, now here again, what we are reporting, you have to be very careful whether you can really identify those things. If the X company has given Y to Y company and which is holding 20%, and you are the assessee, but still you will be taxed because it is deemed dividend in your hands. Now, how do you know this? You are not auditing the other entity's account, so you can know that there is a loan to third party. So you have to give a disclaimer in that situation. Now again, this is GST. GST basically is you have to very important because you are supposed to do this audit by September, completed by September. The GST 9 and Form 9 and 9C is due by December. So the assessee might not have even compiled this data because what you are supposed to say relating to goods and services exempt from GST, you are supposed to give the amount, what is the purchases made, and what is the expenditure in relation to a composition scheme. That means what purchases are made on composition scheme, what purchases are made from the unregistered dealer, what purchases are made from registered entity. So all that thing, the data may not be available with the assessee at the time when you are doing the tax audit. And it is a voluminous data, full entire year's purchases you have to analyze, even not only purchases, even expenditure, because GST is applicable even on the stationery, printing and stationery, everything, professional fees, audit fees, everything you have to check. So it is very tedious and impossible in the audit. The assessee may not have the data or broken up into these columns. So in that situation, disclaimer is a very easy option. And unless the system is able to provide the data, and if you are able to verify it, fine. Otherwise, disclaimer is a very easy way out. Now, I'll just quickly take 2 more minutes to explain you what are we supposed to do. We are supposed to follow auditing standards. And the documentation, the SA 230, which is the standard on documentation, is the heart of auditing standard. And I will give you one very basic example. I mean, forget about all this tax audit and everything. Simple, basic, personal example I will give you. Everybody here who is attending this lecture, I'm 110% sure when they get up in the morning, first thing they will do is brush their teeth, and then only they will have their breakfast. I don't think anybody here will have their breakfast without brushing their teeth. Why? Right from childhood, we have been brought it that way. No, mommy has been telling us, oh, beta brush karo pehle before eating. And it is inculcated into our system. It has gone into our blood. And even if you are half asleep, it will automatically happen. Same way, how can you sign an audit report without documenting? It should be in your blood. It should be in your system that without having the proper documentation, you should never think about signing any audit report. Why? If you have done an audit, perfectly fine, everything fine, you don't have an audit file. Suppose you have not maintained audit file. You have gone and worked very hard. God forbid there is a disciplinary action, and you have to appear before a disciplinary committee. You go and appear without any papers, without any files, and you talk for 2 to 3 hours continuously before the disciplinary committee. Explain them, oh, I worked 24 hours, I did so much, I know everything. You ask me, I will know everything. The disciplinary committee will hear you. At the end, there will be an order saying that you are convicted because you have failed in your professional view. But instead of talking, if you put 2 files or whatever number of files before them, it could be soft files, it could be hard files. Not necessarily that it should be soft, hard files. You present those files and those files talk for you instead of you talking, and explain whatever is you have done, whatever you have signed, whatever is your audit process, everything, whatever questions are there, the answers are there in that file. You will get a clean sheet. Whatever it may be, there might be some error, there might be some mistake, but then you have done the process. If the process is done properly, you are not to be condemned. So that is very important. We have to follow the process, because true and correct is very important. And I mentioned to you those kind of serious situations. It is a very high responsibility and trust which has been reposed in us by the department, and we have to. Now I'll share with you a few. 1 minute, I'll just share. Last month I was in Kanpur giving a lecture in the CIRC, and our president, honorable president, had come for the opening, inaugurating that particular session, and he gave on opening remarks. And he mentioned one very interesting thing, that today we have got about 4 lakh chartered accountants in India and all across the world, and about 8 lakh students. Totally 12 lakh is our strength in terms of students and members. Today, that is the largest educational institution in the world. No other, and you show me any other education institution having so many students and members. No, they had approached Singapore government, Singapore CA to make an affiliation so that our chartered accountants can become members there by appearing some extra papers or exams if they feel that way. They initially refused. And it is what the honorable president mentioned in that address. And he said they initially refused, but then they invited them to the World Congress they had organized, conference they had organized. So they came and they saw our strength, they saw our presentations and all that. And later on, they approached us saying that we want to, make you as a partner, and any chartered accountant, Indian chartered accountant who stays in Singapore for 6 months can automatically qualify for getting into our Singapore, this membership without appearing for any exam. That is the credibility we have got as a chartered accountant. And I would request all our members to uphold this particular credibility which we have got, the name which we have got, a CA which is there before us. And that is very important, because it is very difficult to come to that level where we build up this reputation. It is very easy to break that reputation. It will take 2 minutes. So I would humbly request all of our members to follow this auditing standard and comply with all this. There may be so many pressures of this from the clients onward, but you must follow this correct process of auditing standards and comply with these things, and then you will never have any problem, and you don't have to worry about it. I rest my this work, and if there are any questions, I'm willing to answer. Thank you very much.
Seems there is no question on the chat box, sir. We were supposed to take the questions as per the chat box. There is one question flashing up just now. Mr. Banerjee is writing a question as per the guidance note. Turnover for the derivative option trading is sum of favorable and unfavorable transactions. His query is that whether the same turnover will be reported under clause 40, details regarding turnover, gross profit, etc.
Yeah, very nice question. Very beautiful question, and I appreciate that. There is a very clear-cut guidelines as far as F&O is concerned. Now, F&O is a different type of a business. It is not like a normal sales and purchase which we do in our normal case. It is the futures and options, and there is a specific circular, and the turnover is determined how the turnover has to be worked out. Turnover has to be worked out not by the actual sale, because the sales will be in millions and millions of rupees. You cannot even calculate, because what you are looking at is the small fraction of that amount. The turnover has to be computed very in a different manner, and it is very something very unlogical, but it is that way. Let's say you have made a profit, let's say of 1 crore in some transaction. You have done so many transactions. 1 crore is what you have made profits in some transactions. In some transactions, you have made a loss of let's say 2 crores. What is the turnover? Turnover is 3 crores. You have to add profit and loss, and then that is our turnover. So it is something which is unusual, illogical, I agree, but that is the way it has been designed. So we have to report that as a turnover, and all our computations for the purpose of tax audit applicability, all that we have to apply 3 crores and not 1 crore or 2 crore. It is not net. There's 1 plus 2. You don't have to do 1 positive minus 2. I mean, that's what we know in our normal accounting or arithmetic, but it is not that way. It is 1 plus 2. I hope I have clarified.
So, Mr. Banerjee wanted to whether this turnovers need to be reported in our clause 40 of the tax audit report. So, what you opined, sir, we need to report this turnover in our clause 40, right? And we also need to report the gross profit emanating out of this turnover.
Now here, yeah, very, very interesting. Gross profit is a different term. Gross profit is only for goods and service, goods, not for services. And for services, you're not supposed to give gross profit. You're supposed to give only net profit. So here, this may not qualify under the goods. I don't think shares are under goods. I mean, this F&O is not considered as a share, as a goods. So you can safely give only net profit, because how will you compute? Because this itself is a profit or loss.
Okay. So there are no more questions in the chat box. I have got a very small queries regarding this LLP books of accounts under this section 44 capital AA. Whether we need this maintenance of the books of accounts is mandatory for LLP. Like in the case of a company, it is not mandatory as per the guidance note. But for the LLP, there is no prescribed thing. So what exactly is in your opinion? For LLP, whether the books of accounts are mandatory under clause that section 44 AA?
So now, yeah, I'll explain you this. In case if audit is applicable in case of LLP, we definitely books are mandatory, because without the books you cannot. In the LLP, there are 2 categories. There is one where the books are, audit is mandatory. In the other case, books are not. The audit is not mandatory. Now, if you see the section 44 AA, there is a requirement of maintaining books 1,20,000 I mentioned. For that individual LLP, individual and HUF will not apply because it is other. So 1,20,000 is the limit, and it is 10 lakhs. So if you have this, then you have to maintain books. It is compulsory from the income tax perspective, section 44 AA. Now LLP Act, yes, because they have to submit some financial statements on a yearly basis, and it has to be certified by a chartered accountant. So how will they certify unless and until it is?
They maintain books of accounts.
Yeah.
Sir, the second question which I am having in my mind regarding this loan transactions, nowadays the loan transactions are also having multiple variants. There may be an RTGS, maybe NEFT, maybe UPI, maybe account pay check, maybe draft. So whether what should be our disclosure in the tax audit report? Shall we disclose overall like by electronic mode, or we should show all the transactions separately by NEFT so much, by RTGS so much, by UPI so much, or by account pay check so much? What is in your opinion, whether the separate disclosure is recommended, or whether we can add it up and just show by electronic mode? Yeah,
very good question. See, as far as the disclosure in 269 SS and P is concerned, it first asks you a question that whether it is, there are 2 to 3 types of disclosures here, 2 to 3 types of clauses. One clause says that anything other than banking account. So that means cash. If there is any payment by way of cash, that is separated to this. If there is otherwise than way of a pays account check, or by through otherwise than through that electronic mode. Now, electronic mode will be all NEFT, whatever UPI and GPay and all that, whatever, everything will come under that. So here you can just say that it is through electronic mode. Now, in our office, we have a practice. We will show separately. Suppose, for example, there are 2 loans by NEFT and 2 loans by RTGS. We show it separately, because then there is a separate mode. Of course, NEFT and RTGS are also banking channels and permissible banking channels. But it is always better, what you say is right, better to show that, because you are showing which mode it has been paid by. And otherwise, pays account check, we have to give a disclaimer, because pays account check we cannot come to know. Right. NEFT we can come to know because it is there in the bank statement, whether it is NEFT or RTGS. But suppose if there is only a clearing, we don't know whether it is pays account check or it is a cross-sell order check. Yes. Thank you, sir. Thank you so very much. Over to Sanjay Jain, Deputy Convener, sir.
Sanjay ji, yeah. Over to Deputy Commissioner, sir. Sanjay ji, you are there now?
Not audible.
Yes. Just a minute.
Pawan ji has joined.
Pawan ji has just left out
Oh,
due to some
okay.
technical reason. Pawan ji, have you joined?
Yeah, join कर रहे हैं.
Okay. So meanwhile, sir की उपस्थिति का कुछ फायदा उठाया जाए. When sir is there, तो let us take some advantage of the sir. Sir, regarding this 40A IA, 40A
Yes.
1A, small
Yeah,
1A, if the taxes has not been, Pawan ji, have you joined?
Yeah, Pawan has joined, I think.
Yeah. So
Yes, sir.
over to Pawan ji for offering a formal vote of thanks to our learned guest speaker, sir. Sir, your entire deliberations was excellent, and you prepared a beautiful PPT. I must see. When I was throughout the session, I was just glued to your PPT and your deliberations also. It was very, very well prepared PPT and your deliberations too. So over to our learned Pawan ji Agarwal for offering a formal vote of thanks to you, sir. Over to Pawan ji.
Thank you, Anup ji. I thank a lot to Mr. Goawala, who has lucidly discussed not only the requirements, but also some of the relevant issues under the various clauses. And he has discussed clause-wise, he has analyzed clause-wise. Even, you see, he has very well explained various provision of ICDS, say percentage completion method, warranty, mercantile system of accounting, etc., and when it will be applicable or it will not be applicable. He has very well explained, say clause 17, where 50C or 43CA is applicable, that 10% clauses. He has also very well explained 194R, which was recently introduced, and many of us are sometimes not able to analyze it properly. He has explained 48(2)B, and the chart, a nice chart has been prepared by him. He has also explained 43B, and he has equally explained the need of section clause 44. Clause 44 also. So thanks a lot, sir. I also thank the organizers. I also thank all the participants who has duly given their time during this period of our audit, etc. And thanks a lot, Goawala sir. During this, amid this time, you have contributed your time, valuable time. So thanks a lot, all of you. Over to Anup ji.
सर मैं कुछ ऐड करना चाहूंगा.
जरूर सर.
अनूप जी, मैं आपके परमिशन से ऐड कर दूं कुछ?
प्लीज सर, प्लीज. आप डिप्टी कन्वीनर है सर, प्लीज.
गोवा वाले सर जी ने मुझे कुछ टेम्पलेट्स वगैरह शेयर किए हैं टैक्स ऑडिट से रिलेटेड. मैनेजमेंट रिप्रेजेंटेशन लेटर, क्या अंडरटेकिंग्स लेनी है अपने को क्लाइंट से, क्या क्या डिस्क्लोजर रिक्वायरमेंट में किस किस पॉइंट के इसमें क्या डिस्क्लोजर देना है, जस्ट टू सेफगार्ड आवर सेल्फ फ्रॉम एनी अनफोर्चुनेट सर्कमस्टेंसेस. वो सब चीजें मैं जितने में डेली पार्टिसिपेंट्स हैं उन सबको शेयर करेंगे उनके ब्याप में. सम टेम्पलेट्स हैव बीन शेयर्ड बाय देम. उन्होंने मुझे दिया है, मैं उन सभी डेलीगेट्स को दूंगा जिन्होंने भी रजिस्टर किया.
थैंक यू.
So nice of you, sir.
संजय जी, सर को वो मोमेंटो ऑफर कीजिए.
सर आपको दिया हुआ ना?
अच्छा, ओके. एक मिनट, मेरे डेस्कटॉप में है. शेयर स्क्रीन. संजय जी, आप शेयर कीजिए, मैं अपने डेस्कटॉप को ले नहीं पा रहा हूँ.
ठीक है.
मेरे डेस्कटॉप में है मोमेंटो एक्चुअली. Would you able to do it, Sanjay ji?
Just a minute.
Sir, in this virtual meeting, we could only able to offer you a virtual memento, sir. We would really love to, we will really love to have the physical memento when you will be in Calcutta. The entire deliberations, as Pawanji said, is excellent, in fact. And I am pretty sure all the members who was present here must have been immensely benefited out of your deliberations. And with your permission, sir, we'll be going to share your PPT amongst all the members. So many of the slides were more than like, it was far excellent, including that chart which our Pawanji has also told. So with your permission, we'll be going to share your PPT amongst our members. It was
Well,
really
you
an
can go
excellent
ahead, and love and affection is very important. Memento is, I mean, it is intangible, but it is your love and affection is always remain with me. Thank you.
Thank you, sir.
Our gratitude towards you, sir.
Yes. And I look forward to meeting you all in Calcutta whenever next time I am.
Please, sir. Please, sir. Thank you so very much. Much obliged. Much
Thank
obliged.
you. Thank you. Thank you. Thank you, everybody.
Thank you, sir.
Thank you, sir. Thank you a lot.
Let's conclude the meeting.
Thank you, sir.